So today I'm working more on stock market research. That means working on my Python model. Let me pull up the PowerPoint real quick. So here's how the model's done. Um, oh, well, that's not the model, but let me show real quick the outline. So this is what I want it to look like. I want to, sorry, I've got some sleep in my eye, but I want it to train on, um, let me turn my light on, and you can see my paintings better. So I want to train on all sorts of stocks, define a universe to train on, get a good return predictor or stock ranker or something like that, which tells me, this is going to go up or down. Um, and then there's going to be a layer on top of that, which manages the stocks in a sector. And then there's going to be a layer on top of that, which manages the portfolio. So this is the initial idea. Um, that's aligning the data. So when I tried fitting models, I see here's a model that clearly outperforms a universe, but I was picking the universe very poorly. You can see that the stocks are just going down, and this was a bull run for the S&P. So this is while the S&P is going up. So bull run for the S&P, and I'm picking stocks that are going down. I kind of refined the picking strategy a little bit, and got it to be better. Now you see here I was picking stocks that are slightly worse than the S&P 500, but not so bad. And then I was slightly outperforming the stocks I was picking, but I was still underperforming the S&P, which is bad. Then I tried to add some more advanced portfolio allocation, fit it to a sigmoid curve based on predicted returns. And then I went from making money to losing money, so that was way worse. Um, then I got oh no, this was cheating. So this I thought was working really well, but it was working too well. Um, yeah, so then I got this result, basically matched the S&P 500, which is a pretty good result. If you can make something that matches the S&P, that's not bad. The S&P is well respected, but it's also like, why would you spend all this effort making picks and changing things? You can just buy the S&P instead. Um, yeah, so then I found that I don't really know what that is, but the key here is that here I'm using N as the number of stocks in the training and test universe. So this shows that the more stocks that I tested on, the better it does. Train and test on. Let me see. Okay. So training. Yeah, if I'm using a smaller universe to train and test, I go from beating the S&P 500 with 500 stocks to basically matching it with 50 to losing to it with 10. And so we want as many stocks as possible in the training universe from one point of view, but also remember here you don't want junk stocks and having too many. This is just picking the top 1,000 by volume from the previous month. This was much better, top 1,000 by volume, and then, the rest of this filtering logic. And so then here I found that, okay, so I'm training it with the 500 stock universe that updates once a month. So then I looked at the number of picks, and it became clear the best result here is this, with where I'm only making one pick. And then as the number of picks increases, the performance gets worse, 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 until it's basically matching the S&P 500 at 200 picks, and then at 500 picks, it's worse than the S&P 500. But then, my intuition says, well, if you have, maybe you're underperforming S&P if you have 500 picks, but you're way more diversified. That's a much more stable portfolio. And this isn't really a good assessment region because the S&P's been in a huge bull run, with the exception of this tariff drop. So at least the tariff drop is nice. You can see how it performs in a massive downturn. And so the next thing to look at was what is the Sharpe ratio as a function of number of positions, and also what's the drawdown. So According to the internet, you want a Sharpe ratio of 1 or above. And the only one that has this is if I am picking one stock. But then it also has this risk where the drawdown. Oh, I forgot. This isn't really too much of a risk. The max drawdown's the same. I mean, not the same, but the range is from 0.22 to 0.3. And so it's like, oh, here you're risking, a 1/3 drawdown versus a 1/5 drawdown. That's worse, but 1/5 is still really big. And if the Sharpe ratio is higher, I'll eat the drawdown. So this one's really interesting, because here it's like, okay, you have a strategy that barely works with one stock. But here if you say, so it's predicting a return. So what I'm doing here, what I trained this on, is I'm saying if the return is, if you're going to have a positive return, buy it. Zero or negative return, don't touch. And then from that, rank from the greatest to the lowest predicted return. And remember, Sharpe ratio of 1 is what we want. So now if I'm training with one stock and then I make a threshold, you see Sharpe ratio is just below 1. If the threshold's 50, so just buy anything predicted to go up and then wait, WEIGHT it. Increasing to 0.51 doesn't really help at all. Increasing to 0.52, we see a slight increase, but then 0.53, big jump up above 1.5, and then 0.54 is a big jump up to 2.5. And so that is really good. But then you see here that 0.53 performs the best. 0.54, also 0.5. What is this? Yeah, 0.5 and 0.53 both look like they're making a lot of picks. And they follow each other at times, like here. And 0.53 really differentiates itself here. 0.54 is lower than everything else, but look at the volatility. It doesn't have that wild volatility. You could also see during the COVID crash, it was, or not COVID, tariff crash. Before the tariff crash, we're well below, and here is the first giant drop from the tariff crash. No, I'm wrong about that. This is the tariff crash. So I guess the point is this avoided the giant drop. But today I'm going to look more into this and see how can we get something that is really robust. I really like this 0.54 threshold. But I'm going to have to work on it some more to get a good strategy. The next step is kind of getting a more robust testing framework and doing a walk forward method. This is just a training test split. So I have data going back to 2011. So I want to find some bear regimes in that time. When's everything getting crushed and how's the model doing that period? And then for the forward walk, it's like train the model on, say, the previous year. Maybe, what is a good window to go back on training the model for the subsequent month. So there's still a lot of things to look at, but I have a pretty promising strategy. Sharpe ratio above 2.5. Returns of 1.5 is the log return over 2 years, a little over 2 years. You see the S&P in the same period, beginning of 24 to beginning of 26. The S&P is making log returns of just over 0.3. And so this has a really high Sharpe ratio, and it's really beating the S&P. And so that looks really good. Next thing is test it more robustly with the walk forward method, and then look for better ways to get returns. So I forgot, I have to put a comment in the chat. Thanks for watching. I work on this every day. Subscribe if you'd like to follow along, exclamation. Okay, so the next thing I'm going to do before working on the model is updating my Bitcoin trade, which is betting on Bitcoin to go down. Bitcoin follows regular cycles. I'm making the assumption. Oh, this is also not financial advice. Don't take this. Don't do this. This is entertainment. It's entertaining. It's entertainment. And so I'm betting on Bitcoin to go down by the end of the year. And my price target is 69,000. That's because it follows. Oh, I thought. Yeah, there we go. So it's following this ratio. I'm messing around with the end value here because we're in the fourth cycle. If you take the 2013 peak to be the peak of the first cycle, then that means we're in the fourth cycle. You see that the all-time high occurs just under every 4 years. So December 2013, December 17, that's 4 years. To November 21 is 3 years, 11 months. To October 25 is 3 years, 11 months. And then the local minima, the difference between these was 3 years, 11 months, 4 years, and then 3 years, 11 months, 4 years. And then, so what I'm assuming is that this cycle will continue and we're going to hit the local minima 4 years from the previous, roughly, give or take a month or so. And then I'm looking at the ratio of the all-time high to the minimum of the trough. And so you see the peak ratio has fallen off significantly from above 6 to 4 to just below 1. And so I need to look more into this in the coming months, but my assumption is that it can't. This looks linear. Ignore the last data point, but these three look linear. But it's not going to go negative because the price of Bitcoin's not going to go negative. And so what I'm assuming is this is actually a log trend. And so a conservative assumption, assuming this is a log trend, then each cycle it should go lower. And you could also assume each cycle, maybe this is overreaction from the giant FTX news, which really no crypto stuff had made news like that before. And so I'm making the assumption that it's going to be 1. And so if it's 1, then it'll go down to 69,000. If that happens, then the price of IBIT, the BlackRock Bitcoin ETF, will be 42.50. So those are the assumptions I'm making. And based on those assumptions, I bought a put on IBIT at $45 to expire in June of 2027. And that will give me time to sell it because I can't afford to buy 100 shares. So that'll give me time to sell it before what? Before the trough, or at the trough. So I'm documenting the price of my option every morning, and then also the price of IBIT. So that's the first inverse Bitcoin play I have. 630, it was $810. So let's put 810 here. And today is the 29th. It's almost the end of January. And Bitcoin value at market open this morning. Wow, Bitcoin's getting crushed all the way down to 85,000. Okay, at 6:30 market open. There's 87,596. And then let's update the put return. So Bitcoin goes down, put value goes up. Pretty simple. 49, that's the best profit so far. Okay. Now the other thing I've been doing is buying inverse Bitcoin, BTCZ. There are two inverse Bitcoin funds. Well, I guess the next thing I did after the first thing I did was buy the put, and then I sold an inverse BTCZ put at $4 for $45 to expire February 20th. And then I bought shares of BTCZ. And Bitcoin's getting crushed today, so I don't want to buy any more shares. Today's the 29th. Still hold 88 shares. Total cost is the same. And what was the price at market open? BTCZ. Wow, it's up to 426. So at 6:30 this morning is at $4.05. Okay, so now I'm only negative $3 as of market open. Now I'm positive because it's like 426. Okay. Anything else? And altogether, this makes 2/3 of my portfolio. So this is a big bet I'm making. Okay, so that's the end of the Bitcoin update. Save. Okay, so back to the model. Did I put a comment in the chat? Yeah. Okay, so plan moving forward. I want to do the walk forward analysis, and I want to test this more robustly. 0.54 is really good. Okay, now I need to open the code. And you can see this is kind of becoming a mess. So I basically want to do the walk forward analysis and then clean everything up because this is way too many files, way too much crap. Yeah, I can't upload all this to GitHub. And then there's so much in the data. Yeah, it's really just, yeah. I can't save all this crap. Yeah, so going forward, I want to clean this up. I've got way too much crap going on. Portfolio picks v3. I think that's the script I ran. Okay, let's get out of here. Stock market tool. Portfolio picks v3. And really I need to update the GitHub at some point because I stopped doing that when everything became such a mess. Yeah, so here we go. This works really well. The 0.54 method. Oh no. Why does it start at 1? Okay, that's an error. We shouldn't be starting at 1. So I said this is beating the S&P, but really it's going from 1 to what? Just over 1.5, so making 0.55. What'd the S&P do? 0.3, so it's still beating the S&P. I'm gonna go get a cup of coffee real quick. well. It'll be good to have it going on the weekend. Hey, buddy. All right. So let's look more into this model. I was looking at the gold price. So, I mean, this is just crazy. If you'd bought gold during COVID, it's now worth close to quadruple. And then let's see, when did Russia invade Ukraine? It was February 22. So look at gold since Russia invaded Ukraine. $1,800 to $5,500. That's crazy. I mean, this is the problem. When I got interested in this stuff, it was after the 2008 crash, maybe like here. And so I've just watched gold be flat and slightly decline my whole life. And yeah, I remember looking when I graduated high school going, if I'd bought gold in 2010, I'd have lost money. And so then you look at that, that doesn't look like a good asset, but I got tricked. Google AI Studio. This is just so exciting. Let's pull up the Bitcoin chart. It's so exciting. Down to 84,500. Wow. So what is the resistance here? Whoa, it crashed through the resistance? Oh no, okay, that went all the way down to 84,200. So if we go below 84,000, we're full on in the crash. When did I buy Bitcoin put? January 20th. Here. So pretty good play so far. 810, and now today, right now, it's worth 878, so now it's gone up $68 today. Wow. That's crazy. So 20% of my portfolio is in BTCZ. That's crazy. Okay, I gotta focus. I honestly don't have that much time to work on this, so let me just make a plan. Okay, so what do we say? I have So why does this start at 1, I guess? Let me try to troubleshoot that. This isn't the return. Cumulative growth. But this is log returns. So I'm plotting curve. Curve is 1 plus picks, where the prediction is greater than the threshold, and do net return. So when's net return? So it's open. Okay, actually I think this might not be working correctly. Yesterday you wrote this script which tests different thresholds for my portfolio strategy, but I think it's incorrect. Why is net look at where net return is defined in the data frame? This is incorrect. I want to visualize the log returns, not the net return, and then say so portfolio picks v2. I just can't stop looking at my account. When was this peak? 2381. Yes, I've passed my all-time high. Okay, so I want it, yeah, that's what it runs. I want it to show log returns. So we want portfolio picks and portfolio picks v2. Portfolio picks v2. So Bitcoin's fallen from, I guess it started falling yesterday. Oh, I forgot the time's wrong here. I don't know what the fuck to make of this. So it's currently 3:52 p.m. Oh, it basically started falling at market open. I guess we could say if it goes below 84,000, we're good. See what it says. Change the back test to return gross log returns, SPY integration. Alright, let's just see how this works. Well, I liked the other plot better. But this, you see in log returns, oh, it's trying totally different strategies. I'll double check LGBM v5. This is a big problem for me with all my projects. They turn into a nightmare. Okay, so where do we do the trainings? Split, training test, split. Validation cutoff is 0.85. So everything, the last 0.15 is into training, and then in portfolio picks, change that to 0.9. And then does it perform as well? Oh, wrong script. Yeah, still works. That looks basically exactly the same. So, let's go back to here. V3. Oh, that was in V3. I did that. So let's do V3 again. Yeah. Okay. So the next step is really to put this all in a Python model where I can test robustly. So one 29 2026 goal for organizing goal. Organize data for more robust analysis of model. So in single class train and test model. Okay, so inputs. We want to say training strategy, universe strategy. Which predefined universe to use. So put universe into class. So it should retrieve the universe if it's not saved yet. If we already have that universe saved, we need to save it. So we need some like identifying filters and characteristics in metadata. Saves to folder. So that should be standardly defined in single class train and test model. So we want to put the universe strategy in. Let's add train years to train on. We also want train test split. And we want an option to, I'll add that in later because that's too complicated for now. Yeah, sorry I left to go grab coffee for quite a while. That kind of messed this stream up. This won't be a good stream, but then I'll do another one tonight. In single class. So train test split, universe strategy, years to train on, train test split. And then we want to visualize so we have inputs and methods. Visual, so we want to train, test, visualization, options for the test. And then once all this is done, not years, we'll say strategies. Okay, so that's what I'm going to work on tonight. That's it for now. I've got to go to work and walk my dog and eat breakfast. And